Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. This is also known as the diamonds. You might be familiar with that. And as I zoom in here, you'll see, like I do each and every week, I left my lines on the chart from last week's forecast, and I did say we would go lower. We have not yet hit the target point right there, which is 301.32. And I say not yet because all I'm going to do this week is move that on over to the right. We had a little bit of up action early in the week. We closed down today with some pretty heavy selling towards the end of the day, but still wound up slightly above that 20-period moving average. So what I'm going to do is, again, move that on over to the right. I'm going to do my best to try to keep that price target intact. In fact, I'm going to go a little bit lower than that, than last week's price target. And I'm going to keep this support level intact. Why? Because from a risk management point of view, if you're still long the market, and I've been saying this week after week after week, if you're still long the market and not sold out of any of those long positions, I would strongly recommend that you trail your stop up with the price of the stock. So last week I said, okay, put your stop below this low as a support level. And if you start to see signs of weakness, you might even be open to moving your stop up to maybe right below the 20-period moving average. And that's called trailing the stop. If you look down at the bottom, you'll see that the stochastics are pointing lower and the CCI continues to go lower. Interestingly enough, if you look at the top, we have ascending highs, right? We have higher highs, but again, look at that CCI showing lower highs. That's called a negative divergence. And so that's why I'm keeping that forecast in place. I'm just extending the timeline for you and even lowering that target again just a little bit. And hopefully you're doing a good job managing the risk. Now I'm going to flip immediately to the VIX, because the VIX did not hit its target, at least not yet. It tried to do that. I'm going to, again, keep that high resistance level up here for the VIX, right around 28.5. I'm going to keep that in place because look, as I erase these lines, I'll reestablish this as soon as I clear the lines out to clean up the chart. I'm going to keep that support level right there, okay? I'm going to identify this target right there at that resistance. But look what's happening. Today, we have what's called a spinning top. Let me zoom in there for you so you can see that. A spinning top is a small-bodied candle that looks almost like a child's toy, you know, like a dreidel that you spin on the top of a table. And that's why the Japanese called it as such, because it looked like a spinning top, right? Now, yesterday, we have a doji. Dojis and spinning tops usually form at pivot points. You can see that happen back here. There is a doji right there. And those dojis have a tendency to show up like spinning tops. See at the bottom of this pivot point back here, there's a spinning top. And therefore, I am forecasting that the VIX is going to start to move up. The supporting evidence of this is found, again, in the oscillators. The CCI and the stochastics are still oversold, but look at that CCI starting to pivot up. So again, that supports higher prices on the VIX. Now, if you've been following along with my market reports, you'll know that for the most part, the VIX is inversely related to the S&P. Let's go take a look at the S&P. There you go. Still trending higher. I'm going to zoom in a little bit. My forecast lines didn't show up on there for some reason. Let's see, give that a little time. The forecast lines didn't show up. Oh, there we go. And that is still lower. And I'm getting pretty aggressive by moving this over to the right, but that's exactly what I'm going to do. I'm going to extend and go out using the same angle. I'm going to go out 2 weeks and continue to keep that price target at the 366 level or thereabouts. A couple of things that are happening on the S&P. Now, if we're bullish on the VIX, we're going to be bearish on the S&P. Here is another spinning top, very close to a doji. You can see that as I magnify that for you. And you can see that today, down below on the CCI has crossed with a sell signal. There's a gap below the market that will most likely act as a price magnet. We have a wide divergence from this 20-period moving average to the price. All of those are bearish signs. And again, I have this flatline support level at the risk management point. So if you're long anything in the S&P, you're going to look at your stock. You're going to draw similar flatline support levels. Keep your stops below. And as the market, if it decides to continue up and not pull back, at least you're trailing your stop up with the price of the stock as it goes higher. Right? So that's the S&P. Looking at a small cap index, which is the Russell 2000 ETF, the iShares, interestingly enough, this is looking the least bearish, if I could say it that way. Why? Because we actually have a bullish engulfing pattern there. Even though the oscillators are going down, a bullish engulfing pattern is bullish. I'm not going to continue this right away. I'm going to make this look a little bit different. I'm going to condense the price axis. I think the Russell 2000, because of that bullish engulfing pattern, could go a little bit higher before pulling back, but I do think it's eventually going to pull back. So what does that mean? We have a gap below the market. That's going to act as a support level. I would keep your sell stops in place below that support level. And if the Russell 2000 goes higher, I would move my stop up to trail just below the 20-period moving average. So again, trailing the stop is a strategy that will help you protect profits along the way, while at the same time, if you're getting into any new positions, it helps you reduce the risk along the way as well. So that's the Russell 2000. Now, if we look at the Qs, take a symbol QQQ, same thing, more or less the same scenario repeating over and over again. It didn't even come close to pulling back to that support level. So what we're going to do is I'm still going to say we're going to pull back, but this time I'm going to have to move that target up a little bit to the 20-period moving average. All right, so what are we doing? We are moving that support up to the 20-period moving average. So if you're long anything in the Qs, any of the tech sector, I would say protect that. This is a doji, and you can see here, as the price is going up, what's happening to the volume. Again, a drop in volume on the way up is a sign of weakness, actually, because it's telling us the buyers are losing out of that momentum. And we're getting hinges on the CCI and the stochastics here and here. And the CCI is actually starting to head down as we had a higher low today. One other point that I want to note right here, as I zoom in here, you'll see that we have a higher low, but we have a lower high. What is that called? That's known as a half signal. We still have higher lows. Again, higher low, higher low, higher low. Today, higher low, but we have a lower high. That's a half signal, and that's one of the reasons why, if you look down at the bottom, why the CCI is starting to accelerate on the way down. So again, all the signals are pointing, protect, 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 move your stops up. At this point, I would not feel comfortable taking any new long positions. Some of you might disagree with that. And some of the haters out there might say, oh, you're all wrong again and again. I'm pointing to risk management, folks. And I am very, very public to let people know that the charts are not going to be right 100% of the time, but they do give us enough clues and enough signals to tell us when to move stops, when to protect, when to get in, and when not to get in. I mean, that makes a lot of sense. If the markets are extremely overbought, then why would you go all in with all your buying power at a high? Doesn't make sense. It's just risk management. Overall, I think the Qs, if I take a step back and look at the monthly chart, overall, to me, that just looks like an extremely overbought market. Month after month, you can see over the past 5 months, the volume has been dropping. Month after month on the Qs, look, higher highs. But look at how the CCI is going lower. And we see that the CCI is one of the best leading indicators, especially when you're talking about managing risk. That tells me I'm not going to be comfortable buying any new long positions in the tech sector, especially at those highs. So I could sit on my hands, sit on my cash, wait for a pullback. If I expend all my cash and I have no more buying power left, then what am I going to do if the market pulls back? I have nothing to do to participate in the new lows, or as the markets pull back to find a new support level, there's nothing I can do except sell out of the ones that I bought at the top, and I'd be selling out of those at a loss. So be really careful. Just use your charts, use common sense, use good risk management principle, and I think you're going to do just fine. So have a great weekend. We'll talk to you soon. So long.